July 25, 2012. A software engineer at Knight Capital had just installed a new trading algorithm called the Retail Liquidity Program on the 8 servers they had. At the time, Knight Capital was the largest trader in American stocks. Everyone was optimistic about the new program, but what they don't know is that embedded in server number 8, a simple piece of code that will make the United States' largest stock trader disappear forever. August 1st, 2012. The day started just like any other day at Knight Capital. Traders came in, coffee in hand, ready for another day in the markets. The company had just launched the new trading program called RLP. This was the first day the program goes live. Everyone was excited, but no one expected the chaos that was about to unfold. The market opened at 9:30 a.m. and Knight's trader got to work. Orders started flowing in and their trading system began processing them. But soon, something strange started to happen. A trader noticed that the system was buying and selling stocks in a way that didn't make sense. Buying at high prices and selling at a loss again and again. At first, it seemed like a minor glitch, the kind that happens from time to time. But as the minutes passed by, it became clear this was no small issue. Their trading system was out of control, making trades on a massive scale. What could have become a routine morning was quickly turning into a disaster. The system had gone rogue and the traders didn't know how to stop it. But this chaos was still happening inside the company's walls. All of this was about to change when outsiders starting to notice the disaster. The computer analysts at New York Stock Exchange noticed that market volumes were reaching an all-time high. These numbers are double the normal market volume in any given day. They felt that something was off, and when they dug a little deeper, they found out that these volume spikes were coming straight from Knight's Capital. They immediately called the company's CEO, Thomas Joyce, demanding an explanation, but Joyce was nowhere to be found. He was still recovering from the knee surgery he had done in the prior days, so they reached for the company's chief information officer, and they were surprised to find out that the company's CIO didn't have a clue of what was happening. This was humiliating for him, but the company's CIO is about to get into a much more difficult situation when they ask him to take the following action. The company's CIO gathered all of the top IT staff to figure out what had gone wrong. They traced the problem down to the new trading algorithm. But what had really surprised everybody was the company did not install a kill switch code inside the new trading algorithm, which means that they didn't have any control over shutting down this bot. A newbie mistake any beginner programmer would have fallen into. But those were not beginners. They were the lead programmers in America's largest stock trading firm. Precious time was slipping away. In an attempt to control the disaster, they decided to make a move and mask the mistake they had done. Little did they know, this move was like pouring gasoline on a small fire, setting the stage for the entire building to burn down. In the rush to fix the problem, they made a huge mistake. Instead of shutting everything down, they decided to roll back to the old version of the code. And where is the old version of the code stored? Server number 8. The same server that contained the simple piece of code that was responsible for all of this chaos. Right now, all 8 servers were running the defective piece of code. And just like this, all of the company's trading servers were turned into money-burning machines. For the past 4 minutes, the company was losing money 7 times faster than it originally was. The servers were buying high and selling low every single transaction, with hundreds of thousands of transactions carried out every minute. It wasn't until 9:58 a.m. that the engineers fully realized what was going on. They shut down the trading system on all servers, but by then, the damage was done. Knight Capital had executed over 4 million trades, buying and selling nearly 400 million shares. The firm was left holding a total of $7 billion in risky positions, but the nightmare was far from over. How did one mistake lead to such a massive collapse? And what exactly was the job of the defective algorithm in the first place? Was it placed there by accident, or did someone place it there intentionally? The evil algorithm that was embedded in server number 8 was called the PowerPeg. The PowerPeg algorithm was a test program used by Knight Capital until 2003. The program was never intended to be activated in live trading. Instead, they developed it to test their other trading algorithms in a controlled environment. The PowerPeg was used only in simulations to drive stock prices up or down. Activating it in a simulation is productive, but releasing it on a live trading is as if you shoot yourself in the foot. The code was abandoned in 2003 and was embedded inside the servers dormant with no proper use for the past 10 years. A practice programmers call dead code. Leaving that code around is not exactly the proper job to do. In its dormant period of 10 years, the algorithm didn't really do any harm, but thanks to a one simple move done by the company's software engineer, the algorithm was suddenly activated. The company was preparing to install its new algorithm, RLP. that promised a very high trading efficiency. For the program to functionally work, they needed to set its control flag. But what exactly is a control flag? Think of it as a piece of code that, when executed, acts like an on switch for a specific algorithm to work. The real issue started when the developers reused the control flag of the PowerPeg algorithm to now activate the new RLP program. To make sure that the reused control flag would not activate the PowerPeg program as well, the company's engineers had disconnected this control flag from the PowerPeg program in a new code update. This code update was supposed to be installed in all of the 8 servers that the company had, and that's where everything went wrong. In the final rush before the launch, an engineer deployed the updated code to the company's trading servers, but he missed one server. That server was left running the old PowerPeg code. No one caught this mistake. There was no backup check, no automated system to flag the error. So when the control flag was switched on, the new RLP code was successfully activated on the 7 servers that had the new code update. But in server number 8, the PowerPeg was still linked to its control flag. So for the first time in 10 years, it was activated back again. But this time, it was not a simulation or a test environment. It was live trading session using the company's real money. And when the company's engineers tried to think about the root cause of the disaster, they thought it happened as a result of the new code. So they took the old piece of code in server number 8 and installed it on all of the remaining servers. And that's when things started to go downhill for them faster than before. It took them a whole 28 minutes to figure out what was the root cause of this disaster. By the time they figured out what was wrong, the damage was done. Knight Capital executed over 4 million trades, holding unwanted positions over $7 billion. But the real nightmare was just beginning. When the dust finally settled, Knight Capital was left in ruins. The aftermath of such an incident was nothing short of a catastrophe. The trading frenzy that had unfolded over those chaotic 28 minutes left Knight holding massive positions, both long and short, that no one had intended to buy. The company had unintendedly bought high and sold low over and over again. On the scale of the 4 million trades the company executed, it had lost a total of $460 million. But this was not the only problem Knight Capital was suffering from. The firm found itself with a net long position of about $3.5 billion in 80 stocks and a net short position of about $3.15 billion in 74 others. These were positions that the firm neither wanted nor could afford. The market had been thrown into chaos. Prices for many of these stocks were widely distorted. Some shot up while others plummeted, all because of Knight's runaway trading bot. By the time the problem was contained, the financial damage was staggering. Knight's executives were in full-blown crisis mode. The company was bleeding money fast and they had no choice but to admit the catastrophic mistake. The losses were so severe that Knight was on the brink of collapse. With no time to spare, they reached out to their partners and competitors, desperately seeking a lifeline. What followed was an urgent race to save the company. Knight needed a massive cash infusion, hundreds of millions of dollars, just to stay afloat. A collection of banks and trading firms, including giants like Goldman Sachs and JP Morgan, came together to offer a lifeline for $100 million in emergency funding. But it came at a steep price. Knight had to give up a significant chunk of the company. The rescue package was enough to keep Knight alive, but just barely. The firm had to sell nearly 75% of its equity to secure the funds, diluting its shareholders' stakes to almost nothing. It was a bitter pill to swallow, but it was the only option left. But the story doesn't end there. Just a year later, in 2013, Knight Capital, fragile and weak, was acquired by Gadco LLC, a high-frequency trading firm. The two companies merged together to form KCG Holdings. 4 years later, the newly formed corporation was getting acquired, this time by Virtue Financial, in a deal worth a flat $1.4 billion.